We're all in a different position when it comes to paying for a car. One piece of advice doesn't suit everybody. So in this video, I'm going to list the different methods available to pay for a car, their advantages and disadvantages, how to avoid that finance trap that the dealer wants you to get into because it costs you more money in the long term, and how I have saved money when I have bought cars. The most obvious way to pay for a car is using cash. And I don't necessarily mean lots of notes, although you could if you wanted. I just mean cash you have in the bank instead of using finance. The advantages? Well, no monthly payments, no interest. You own the car. The bank doesn't own the car. This can be advantageous because let's say you get a scratch on your car or a dent or the wheel gets curbed and you don't have the money to put it right and you're not really fussed. You're happy to live with it. The car is still safe to use. Well, you can live with it. You don't have to put it right. In some situations when you have finance on the car, you may have to put that right or you're going to be charged for it later anyway. Also, you don't have a mileage limitation. You're not trying to guess how many miles you're going to do that year. If your personal circumstances change and you need to do more miles, you're not going to get charged an excess mileage charge. The car is there, ready for you as much or as little as you want to use it. And you have an asset that's worth money. If you really need the money but don't really need the car, you can sell the car and have the money. Or you can use the value of that car to go towards your next car. Then there are the disadvantages, and they are quite significant. Firstly, just how long it takes most people to save up enough money to get a decent car. It may take them 2 years, 3 years, 4 years, 5 years, or they could just pay a monthly payment and have the car already. Yes, they're paying more because of interest, but that interest is well worth having the car now and not having to wait many years to have it. The inconvenience of not having the car may just be too much. Then there is reliability, because if you are going to save up for a car and just use the money in your bank, you're probably not going to save up the amount of money you would have spent if you got finance. You're probably going to get a cheaper car because it just takes too long to save up that money and you need the car soon. So you end up buying an older car. Older cars generally are less reliable, generally less safe, generally use more fuel. So in taking out finance, you can get a better car that you can depend on, which is safer, and you can have it now, but you will be paying a bit more due to interest. And even if you did have enough money to buy the car outright, you may still decide to buy it on finance anyway. And that's due to opportunity costs. And I'm going to give you an example of how I have bought a car on finance and it actually saved me money over paying for it outright. Quite a lot of money actually. But before I do that, I must explain I'm not a licensed financial advisor. This is not financial advice. I'm a driving instructor and I'm telling you how I have saved money by buying a car on finance instead of paying for it outright. The car was a Mazda MX-5. If you know my other channel, Richard Fanders, you may know the car. I walked into the dealership and I saw the car and I liked it. And I started to want it. And I looked at the price. And I looked at the price again. £30,000 for an MX-5! I didn't know they cost that much. And to be fair, back then, that was 2020, not long before, they weren't 30 grand. They were like 24, 25 grand for a top spec model, but the price had gone up quickly for some reason. Anyway, I really wanted the car and I could buy it outright, but the dealer really wants me to take finance out. And this is the first opportunity I would have missed out on if I bought the car outright. Straight away, the dealer gives me £1,500 off if I take finance. They call it dealer contribution, but really it's an incentive to take finance out because the dealer wants me to take finance. I'll explain later why they want me to take finance. There is a good reason. And they offered me 0%. So £1,500 off the car, 0%, and I'm spreading it out over 3 years. And £1 today is not worth the same amount as it was 3 years ago. Due to inflation over time, those payments I'm making actually become worth less. So I would have missed out on a bit of a discount there if I didn't take out finance, but that was only one of the opportunities. The other opportunity was far greater. I took the money that I did not use to buy the car to pay off some of my mortgage. That meant the balance on my mortgage went down, so the amount of interest I was paying also went down. But because the loan to value of my mortgage went down, my interest rate went down. So I had less balance to pay interest on, and I was paying a lower interest rate. Those two things combined, well, that saved me a significant amount of money. A significant proportion of the monthly payment of that car was made up from me just saving money on my mortgage. If I would have bought that car using cash, well, it would have cost me several £1,000s more. But we were all in different positions. So it really does come down to what position you are in. So you can be better off buying a car outright, but you can also be better off financing it. Which one's best for you depends on your circumstances and the deals that are available. But look into all of your options, or you may be missing out. As I'm talking about finance, I should talk about the risks. Firstly, if you miss payments, well, that's going to harm your credit rating. But on the other side of that coin, if you don't make regular finance payments, you don't build a credit rating, which means it can be difficult when you want to get something like a mortgage. Also, if you miss payments, you may have your car repossessed. Then you don't have a car. And you may find yourself in negative equity, which is something you really want to avoid. Negative equity is when the vehicle you have is worth less than what you owe. This is a problem because if you want to get out of that vehicle, you're going to have to put money towards getting out of it, because the vehicle is worth less than what you owe. So you have to pay to get out of it. And if you can no longer make the monthly payments, that may be the reason why you're trying to get out of the vehicle, you may not have the money to put towards getting out of it. So you may be stuck with these monthly payments. A way to avoid negative equity is to make sure your deposit is big enough that what you owe on the vehicle is always less than what the vehicle is worth. The vehicle is worth more than what you owe. So if you ever want or need to get out of that vehicle, doing so should be fairly simple. It's now the next day, which is why I have a different coloured t-shirt on. I'm going to talk about the 5 main ways you can finance a car. And the first one, a personal loan. This is quite different to car finance because you own the car, the bank doesn't own the car. You go to the bank, they put money in your bank, and then as far as the seller is concerned, you're actually a cash buyer now because the money is coming out of your bank. You can buy from a dealer, a private seller, or even at auction. And as the car is yours, you can use it as you wish. You don't have to stick to a minimum condition standard. There are no mileage restrictions. You can keep the car as long as you like. There's no deposit required. And if you want to, you can sell that car and use that money to buy a different car. Or you could sell that car to pay off the loan, and you can do that whenever you like. Also, if you have a good credit rating, you may find that the interest rate on a personal loan is often lower than many other types of car finance. But if you're buying a new car, you would miss out on the dealer incentive discount to use their finance and also their low interest rate. So you have to look at what deal is available. If you have a bad credit rating though, a personal loan's interest rate is likely going to be higher than that of car finance, because with car finance, the loan is secured on the car, meaning they can offer a more competitive rate as it's safer for them. Also, you risk negative equity. Earlier I said you don't need a deposit to buy a car using a personal loan, but that's actually a problem because it means if you get a loan for the full value of the car, it's likely that the car to begin with is going to depreciate more quickly than you pay off the loan. Meaning if you need to pay off that loan quickly, you can't sell the car to pay off the loan. The car's not worth enough, which is why if you use a personal loan to buy a car, it's a good idea not to take out a loan for the full value of the car. Take out a loan for part of the value of the car and pay for the other part using your savings. Aim that the car is always worth more than what you owe. So if you need to get out of that loan, you have an exit plan. I'm quite confident that the next method of financing a car is going to get me some negative comments for even mentioning it. A credit card. Have you seen the interest rates on credit cards? Well, actually, often they are 0% for several months when you get the deal. And when you use a credit card, again, you're like a cash buyer because you're not taking out car finance, giving you flexibility. The trouble is, the 0% period is usually for several months, not for several years, meaning it's only really useful if you need a very short-term loan. Maybe you need to buy a low-value car and you know you can easily pay it off within that 0% period. Well, it's a way you can get finance on a car for 0%. Or you've been saving up for a car for a while. One comes on the market, right colour, right condition. You've been looking for a while and you know they don't come along very often. You don't know how long you're going to be waiting to find another. Well, you may be able to use that credit card to get you that little bit of extra money to buy that car and be able to pay it off within that 0% period, meaning that the credit hasn't actually cost you any interest. So although credit cards can be a very slippery slope and can cause many problems, if you use them wisely, they can actually save you money. I've never used a credit card to buy a car, but I have used a credit card to save me money on motoring. When I was a new driver, I could not afford to pay for my car insurance in one go. It was too much money. I had to pay monthly, but they charged quite a bit of interest for paying monthly, making my car insurance even more expensive. So you can guess what I did. I got a credit card with a 0% promotional offer, bought the insurance policy using the credit card, and then I paid off the credit card within that 0% period, meaning I didn't pay interest and therefore I saved money. The next way to finance a car is known as hire purchase. This is different to a personal loan. With a personal loan, the bank gives you money and then you use that money to buy a car. With hire purchase, the bank buys the car and you pay the bank monthly whilst you use the car. When you make your final monthly payment, then you own the car. The advantages: if you have a poor credit rating, you're more likely to be accepted for hire purchase than a personal loan. Because with hire purchase, the bank isn't giving you money. They are buying the car and letting you use it whilst you pay them monthly. Also, at the end of the agreement, when you make your final monthly payment, you own the car outright. There's no big balloon payment at the end. And there are no mileage restrictions. So if you need to drive more, you're not going to need to worry about an excess mileage charge. And if you're buying new, quite often there are some good deals, sometimes even 0% or money off. The disadvantages: higher monthly payments. You are paying for the whole car. You are not paying for a part of it and then giving the car back, or a part of it and then paying a large balloon payment at the end. You are paying for that car monthly, but at the end of it, you do own the car. And usually the best interest rate deals require you to have a hefty deposit, which is good because it means you're going to avoid negative equity, but it's bad because it means you need that money up front to begin with. And you don't own the car, so you can't do what you like with it. You can't modify it. If you want to sell it, you can't. You would need to settle the agreement first. I actually used hire purchase to buy this car. This is my 2014 Seat Leon. It's my learner car and I've had it for over 12 years. When I bought it, I wasn't looking for a hire purchase deal. I was just looking for the best deal. I went into the dealership and asked them, do you have any 0% finance deals? And they said no. We got this deal at 4 point something percent, if I remember correctly. And I thought, that's good. All right, good enough. I ordered the car, went home, and it turns out they did have a 0% deal that they didn't tell me about. To access it, I needed a 50% deposit. So I called them and said, why haven't you told me about this deal? And they said, well, we didn't think you had a 50% deposit. Well, I do. So I traded in my Seat IB, for which was 4 years old at the time, and I owned it outright, and I topped up the rest of the deposit with my savings. And the deal was, the car was 20 grand, but with a 50% deposit, I got £1,000 off the car automatically, and then 0% finance on what I owed, which was the cheapest way I could buy this car at the time. Now, what I've been getting to, the next way to finance your car: personal contract purchase, also known as a PCP. I just said that the dealer did not tell me about their 0% offer on a hire purchase. They tried to sell me a PCP at, I think it was 4 point something percent. I don't quite remember the percentage. Why would they do that? They said, well, we didn't think you had the 50% deposit to access this deal. But I had a 4-year-old car that was a big portion of that deposit. So I'm not believing them there. I think they wanted me to take the PCP because it's going to get me on that loop and hopefully get me trapped. So I keep coming back to buy more cars. I'll explain how that works now. How a PCP works is that you don't own the car. You don't even pay for the car. You really pay for the depreciation of the car. So you pay a deposit. Usually the deposit does not need to be large. Then you pay a low monthly payment. And then at the end of the agreement, you have 3 options. You can hand the car back and walk away, or you can pay a very large balloon payment, which is often close to half the price of what the car was new, or you can trade in the car, get another new car, and start the whole cycle again and keep just paying those monthly payments and getting new cars and paying those monthly payments and paying them forever without any end, because really they've got you in a bit of a trap, because that balloon payment is big and the majority of people aren't willing to pay that big balloon payment when they can just keep up those monthly payments that they are used to and get a new car every 2, 3 or 4 years. To be fair though, this is what some customers may want. They want to be on that loop, they want a new car every few years, they don't mind paying monthly, and they want new tech. Just bear in mind that it's likely going to be a very expensive way of car ownership, because you're continuously paying for the depreciation of a new or young car, and cars depreciate a lot more when they are new or young. When cars get older, they depreciate less. If you were to keep the car longer term, you're going to pay a lot less in depreciation, but you are going to start to pay some more in maintenance. But the extra you're paying in maintenance is not likely going to come close to how much you're going to be paying in depreciation if you're replacing your very young or new car every few years. PCPs are used for new cars and young cars, usually under 5 years old. They can be used on older cars, but they are normally high value cars. So the chances are, if you have a PCP, you probably have a very young car, which means it's probably going to be more fuel efficient, more safe, more reliable. It may be under warranty. It's going to have more tech that you may want or not want. And PCPs allow you to buy a car that you wouldn't actually be able to afford without it, because you're not paying for the whole car. You're usually just paying a little bit more than the depreciation if they get it right. And you have flexibility at the end. You can hand the car back at the end and walk away. You can pay the balloon payment and keep it, or if the finance have done their job right, you have a little bit of equity in the car, meaning you probably don't want to walk away. You're going to want to use that equity to go towards the deposit of your next car to get on that circle again and carry on paying monthly and get another car. One of the main advantages of buying a car using a PCP is that you don't risk unexpected depreciation. The car you buy may depreciate way more than you thought it would, but if you've bought it on a PCP, it doesn't matter. You've paid your monthly payments. You know how much you're going to pay. That's what you've done. The car is worth a lot less now than you expected it to be, but it doesn't matter. It's not your problem. You can walk away. Another advantage is the deal. PCPs usually have the best deal because the dealer wants you to take one. They want to give you a reason to come back and trade in the car and get another car. They know the best person to sell to is the existing customer, so they do try. My partner bought a Toyota Corolla on a PCP. She got it on a PCP because she got the biggest discount, quite a significant discount, and a very low interest rate of 1.9%. And when you consider inflation, it's not much of an interest rate. There's no point paying it off early, because the longer it takes for her to get to the balloon payment, in terms of inflation, the smaller that balloon payment actually is. The disadvantage is, as you're only paying a bit more than the depreciation of the car, the bank needs to know how much the car is going to depreciate. That means they need to know how many miles the car is going to do. That means you need to know how many miles you are going to do over that whole agreement, which can be challenging. Your circumstances could change. You could be facing a significant excess mileage charge if you need to do more miles. And as it's not your car, any damages on that car need to be sorted, or at the end of the agreement, you'll be paying for those damages. And you certainly can't sell the car and you can't modify the car until the end of the agreement when you have paid that big balloon payment. And that big balloon payment in itself is a disadvantage of a PCP. The last way of financing your car I'm going to talk about is known as a PCH, a personal contract hire. Basically, that is a long-term lease or leasing. It's very similar to a PCP, personal contract purchase. The last letter is different because instead of a purchase, it's a hire. There's no option to buy the car at the end of the agreement. The end of the agreement is the end. The car goes back. Although it is true, if at the end of the agreement you really want that car, you could contact the company that you're leasing it from, and it's possible they may sell it to you, but they don't have to. One of the main advantages of leasing a vehicle is that you don't pay interest because you're leasing it. It's a long-term rental. But just because you don't pay something that is called interest, it doesn't mean you don't pay. You need to compare the monthly payments of a PCP or a PCH, a lease, and see which one is cheaper. Sometimes one can be cheaper than the other, so that's why you need to look at all of your options. Just like a PCP, leasing offers you predictability. You know what your monthly payments are. If the car depreciates way more than expected, it doesn't matter. You haven't paid for that. You've just paid your monthly payments. In fact, it could be an advantage because at the end of your lease, if you like the car and you want to keep it, well, there may be a chance you could buy it. You could call the company you're leasing it from and say, could I buy that car from you? And if they sell it to you at market value, you're actually saving money buying a new car because you've had the car since new, you've paid a certain amount of depreciation which was predicted, more depreciation has happened, and then you've bought it at market value. So you've missed out that extra depreciation that was unexpected. So it can be, with a bit of luck, a very cheap way of buying a new car. More advantages: road tax is often included, and sometimes you can add a maintenance package which even includes tyres, which gives you a very predictable monthly cost for your car ownership. When you boil it down though, leasing a car and a PCP are very similar. The biggest difference though is at the end. With a PCP, you have the guarantee that you can buy the car with the balloon payment, and you know how much that balloon payment is. But when you're leasing, you don't have the guarantee to buy the car. In fact, it's assumed you're not going to buy the car. If you call the leasing company and ask them if they'll sell the car to you, they may, but they don't have to, and you don't know how much money they're going to ask for. Leasing can be the most affordable way to get into a new car or a very young car. Leasing is usually for new cars or very young cars. But that's not always the case. You need to look into what deals are available for you for the car that you want at the time that you want it to know. There are disadvantages to leasing, like PCP, mileage limitations. Go over it, you're going to pay for that at the end of the lease. Minor damage to the car, don't get it sorted, you're going to pay for that at the end of the lease. And you don't own the asset. If you continue to lease new or very young cars, that's going to cost you more long term than if you were to keep a car long term, or if you were to own an older car. Although you get predictability with the lease, you don't get flexibility, and as life isn't always predictable, well, you could end up having to spend money getting out of that lease if your circumstances change. So before you sign up to a lease for however many years, you want to be confident that you're going to want to keep it for that many years. If your circumstances change and you need a different car, or maybe there's just a new car that you want, you may be able to end your lease early with minimal penalty if you go to the same company that you're currently leasing from and ask them, can I change to that car please? They don't have to, they may not, but as you're getting another lease from them, they may give you a good deal and go easy on the penalties. But that's not guaranteed, you have to talk to them. It can be possible to exit the lease early if you can find somebody to take it over from you. If someone likes your car and they're happy to pay what you're paying, they may want to take your car off your hands. Why though? Why wouldn't they just go and get a new lease themselves for a brand new car? Well, they may not want to sign up for a long contract. You may just have a year left and that suits them. That's all they want. But it's not always possible. You have to check with the company you're leasing from to see if they allow it, and then you've got to find someone who wants to take the lease off your hands. It's known as a lease swap or a transfer of contract. So I've used finance to save myself money when buying cars, but I've also used finance in a less responsible way. I've used finance to buy a flashy car that I just can't afford. I was 20 years old, the year was 2007, and I bought a 2000 Fiat Coupe 20 valve turbo, 220 horsepower, 0 to 60 in 6.3 seconds, green on the outside, tan on the inside with a green strip around the dashboard and the doors. It was lush. It was a Fiat, but it was powerful when I was just 20 years old. I couldn't believe it. I got a car with over 200 horsepower, and I took out a loan of £5,000 to buy that. And I don't remember what the car was worth, but it wasn't £5,000. So I took out a loan greater than the car was worth. Not sensible. In negative equity straight away. If I wanted to sell the car to pay the loan off, well, I couldn't. Fortunately, it didn't go too badly, but I didn't keep the car long because I just could not afford it. Between repairs, I needed a lot of repairs on that, insurance and 20 miles to the gallon, within 3 months it was gone, and I bought a 2003 Seat Ibiza PD130 turbo diesel little hatchback, which eventually I used for driving lessons. So although it's not sensible, I don't regret my decision because I was young and got to enjoy a powerful car, but it certainly was not a sensible decision because if things would have gone differently, things could have turned out badly. I could have been in a position where I needed to pay off that loan and had no way of doing so. Well, if you found this video helpful, please give it a thumbs up, and if you're looking for car insurance, check out the links to Collingwood and Confused in the description. If you're learning to drive and want to insure yourself on somebody else's car, Collingwood are there for you because you can do so without affecting the owner's policy. That takes away a big stress from the owner of the car that you're using to practice learning to drive in. Via the link at the moment, there's up to 35% off and a £20 gift card. If you want to insure your own car, I recommend checking out the link to confused.com because you fill out one quote form and get loads of quotes back from many insurers to compare who's cheapest. And you can change your car on that quote as many times as you like without having to do the whole quote again. So it's a quick and easy way to compare how much it costs to insure different cars. Using the links doesn't cost you anything, but it does support the channel. So thank you very much. Subscribe to get my future videos. And until the next one, cheerio.